me okay? Can you guys hear me okay? Good, all right. So first of all, congratulations. This is probably the nicest, most organized, most active CFA society that I've ever spoken at. And Kelly, Bob, and I, and Mike, we've been around speaking at a number of CFA events. So you guys should be proud of the community you've built here because it's impressive. Most CFA societies certainly don't have weekly events or the attendance that you have. So it's super impressive and we're really excited to be here, so thank you. And secondly, I'm coming to that Great Lakes event. That looks awesome. I want to go to that beer
November
event.
16th, Great Lakes Brewery.
So that looks like a lot of fun. So I'm Sean Kenney. I work directly with our institutional clients here in Ohio, but also across the East Coast, working closely with our partner Kelly Rouleau, who's over there, and Mike Schwannekamp, who focuses on our defined contribution business in this area. And Bob Marren is with us as well. Bob focuses on our institutional consulting partners across the US. And I share that because the context of this presentation is directly related to the conversations that we've been having with plan sponsors and our partners and industry over the past 5 years. So to motivate this conversation, I thought I'd share a little bit of background as to why we're here and why in the world MFS is talking about team time and alignment. Back in 2012, our chairman, Rob Manning, got in front of the entire company and proclaimed that the technology has disrupted the investment business more than Amazon's disrupted retailing. And that was a pretty provocative statement. A lot of people were like, really? But his point was 90% of the world's data has been collected in the past 2 years alone. And actually it's growing exponentially. So information has become highly commoditized in this business. All you have to do is look at your inbox and recognize that information and research is really very, very prevalent in our business. So what does that mean for the investment business? It's our view that most of the investment industry, most investment organizations, many consultants, advisors, and then ultimately institutional investors, plan sponsors, and their investment committees and boards have been oriented around an information advantage, generating a form of an information advantage on the market as a way to outperform. It's our view today that there are two primary sources of sustainable information advantage in the market. One is human capital. So how are you organizing, recruiting, retaining, and organizing your human capital, the people within your organization, to generate some form of an analysis advantage with the information that you have? And the second is time. It's the ability to truly be long-term oriented, to invest counter-cyclically and lean against the market, and to truly be long-term oriented. These are the two sustainable sources of comparative advantage in the market, in our opinion. And as we're out talking with our consultant partners and investment committees and boards, we've recognized that the investment business has a lot to learn in terms of orienting their human capital and their people around more collectively intelligent and effective teams to make decisions. Much of the industry is organized around people's personality and information. So we wanted to help our clients and talk with our clients about how do we take the people within our organization and build more collectively intelligent teams and generate that analysis advantage with the plentiful information that's available to us. So in 2013, we actually partnered with MIT. We looked out of our office across the river to MIT, and so it was an easy partnership in that way. And we engaged in a 2-year relationship with them where we got the opportunity to explore their research centers and their campus. And the research center, there was 3 that we anchored into, but one was called the Center for Collective Intelligence. In this research center, back in 2010, they identified what's called a collective intelligence factor, and they have a ton of research on how to build scientifically highly collectively intelligent teams. So we dug in with them and spent a lot of time with them and participated in some of the work that they had done. And in 2015, we brought 30 of our clients from around the US as well as outside the US onto MIT's campus, and we spent 2 days with those clients in like a think tank type of a conversation with them. It was fascinating. The clients took a lot away in terms of how they could organize their human capital and their people, but what was the elephant in the room of that conversation was the short-term pressures that our institutional clients, these long-term investors, face, is really hampering them. They can't take advantage of that other comparative advantage, which is time. So we decided to dig in on that. We partnered with the IMF and this organization in Australia called the Center for International Financial Regulatory Authority, CIFRA. who's doing a ton of great work on building long-term investment frameworks for institutional investors and long-term investors. We also commissioned our own study back in 2016 around understanding this dimension of time better. And what we uncovered was that actually there's a lot of noise in this business, and there's a lot of good reason why most investors today tend to fail on the dimension of being a truly long-term oriented investor. Even long-term investors today tend to be pro-cyclical and investing along a shorter term dimension that's momentum driven. A lot of good research on that. So where we are today at MFS, we've been out talking around the world on these two subjects in particular. Where we are today is how do you build an alignment system internally within your own organization, externally with the partners that you partner with, in communication with your stakeholders, and with the industry. How do we get the industry to start thinking more long-term, perpetuating a longer-term view? And that's exactly why we're speaking really actively within the CFA. We've been in Charlottesville and talking with leadership within the CFA Institute, partnering with organizations like the IMF and the Rotman Center of Business in Toronto, the Aspen Institute in DC, institutional organizations whose goal is to help perpetuate long-term financial security and generate successful outcomes for the investment business. So I just wanted to share that context because this isn't something that we think is a small issue. We think this is a fundamental conversation that we should be having in this industry. And ultimately the takeaway for people in this room and for our clients is there are actionable things that you can do today to improve both the human capital, the way you organize and orient your teams, as well as how you can build a longer term, more counter-cyclical time frame within your investment horizon. The key is, what are the steps you're going to take to build alignment within your business, within your stakeholder partnerships, and what are the steps that you can take to build that alignment and make sure it lasts over time. So that's the backdrop, the conversation that we wanted to have today. And what we'll do is I'll spend the first few minutes talking about the research from MIT, the collective intelligence factor, and provide some scope for what that is. I'll turn it over to Bob, who will talk a bit about the research around the time horizon. And then we'll wrap up with just a few comments on alignment, and would love to open it up to conversation and get your questions. Feel free to interject and just throw questions out as we go, because I promise you we're not going to be an hour, so we'll keep it short and sweet. So with that, I love starting with this quote because Reid Hoffman is the founder of LinkedIn. He's one of the more successful tech entrepreneurs in the world, and we fundamentally agree. No matter how brilliant your mind or strategy, if you're playing a solo game, you'll always lose out to a team. The challenge is, in the investment business, you could argue we're set up to fail on the dimensions of teams. You really have to take a concerted effort to build highly effective teams based on the structure of our industry, and we'll talk about that. So what is this C factor, the collective intelligence factor? So again, at MIT in 2010, they identified what's called a collective intelligence factor. And what's interesting about their research was they were asking a very fundamental question. Most researchers in the academic community on teams were asking a question: what's team composition supposed to be? What's the best composition of our team? They were asking a very different question. They were saying, can you predict if one team is likely to outperform another? It's actually a really pressing question, and it's important for people in this room because ultimately your job is to predict if the manager you choose or a management team that you're evaluating is likely to outperform another one. So the predictive element is really an important dynamic that this research center was tackling. And what they identified was that in fact there is what's called a collective intelligence factor. The collective intelligence factor, or the C factor, is at least as predictive of team success as IQ is in individual success. And back when IQ was identified, it was one of the biggest breakthroughs in psychological research because it's a highly predictive factor to determine the success of an individual across a wide variety of tasks. So this collective intelligence factor is a simplistic way of thinking about the collective IQ of the team. Now, there were two hypotheses that they tested. The first is where I would naturally go. Well, if you get the smartest people together around a table, they're more likely to outperform than if the collective IQ is lower. That's not true. So this C factor is not statistically relevant or statistically significant to the average IQ of the team members around the table. Interesting. The other hypothesis they tested was, we'll just get the smartest person in the room and put them on the team, and they're going to be the smartest team. Also not true. It's not statistically significant. So there's something else. There's something else with teams that allow really successful teams to thrive. So what are those? Interestingly, it's what they're not. So if you look at the left, you have what's not statistically significant. Not only is the IQ not statistically significant, but the things that most organizations focus on, cohesion, motivation and incentives, satisfaction, are also not statistically significant. It doesn't mean they're not important, and there's a lot of research and we can have a long conversation about where they are important, but they're not predictive. The three factors that are predictive of team performance are on the right: conversation turn-taking, social intelligence, and diversity. So we'll walk through each of those individually real quickly and provide some comments around that. So conversation turn-taking, I love that term because it's a classic MIT term. It's a wonky phrase for just the way information flows across the team. Of course, they call it something like conversation turn-taking. But basically what it's talking about is how information is shared across the team. So I'm a visual person, so I like to look at this slide. So imagine team A and compare that to team B. Both the size of the person and the width of the bar represents the amount of information coming to and from that individual. So on team A, you can see there's really one or two people driving the conversation. Everyone else is participating on the margin. Compare that to team B. In team B, there's a much more equivalent, equal distribution of conversation happening among that team. The research will tell you that team B is more likely to succeed than team A. Now, what's also important about this is that this is easily the most important factor of team performance. Conversation turn-taking, this pattern of information flow, is easily the most important factor that drives team performance, more than the other two factors combined. So I love to think about this because you could sit in a team meeting and just picture this, right? How often does it happen that there's one or two people really driving the conversation, other people are participating on the margin? This is a classic investment committee conversation. Classic. So how do we fix that? We have to have really sincere conversations around the culture of teams within an organization. Getting the voices of junior people out in the open in a team setting. It's very difficult when you think about a junior person challenging an individual, a more senior individual. You could also look at this and say, well, what if team B is just a bunch of people around the table agreeing with each other? Saying, you're so smart, yeah, you're so smart, no, that's a great idea, I really agree with that. That's not collectively intelligent either. So what's important about conversation turn-taking is building a culture where information freely flows and people feel open and the ability to be honest on the team, but it's also so that people feel free to share their point of view freely. This is a very difficult thing for the investment business. You think about the hierarchical structures of the investment business, you think about the type A type personalities in the investment business, you think about the fact that most investment businesses, many investment businesses started with some passionate, really highly intelligent founder, and they dictate and dominate conversation on teams. It's very difficult in the investment business to build a team B type environment, but it is critical to building collective intelligence on a team. The second factor is social intelligence. Now, is everybody familiar with social intelligence? It was popularized back in the 90s when Daniel Goleman wrote a book called Emotional Intelligence. It was the topic du jour for the academic community about 15 years ago, and for good reason. It's been largely said that emotional intelligence, social intelligence is critical in corporate success. We quote the Resource Management of Boston, who's a consultant in the Boston area, where they proclaim up to 96% of success in life and work is achieved through these qualities. I would argue personally this is even more important today. As I look at my kids, who are young kids, the ability to develop interpersonal skills and talents is critical today, because a lot of the analytical horsepower that's being done can be done by computers, and it will be done by computers. And so the ability to get people on teams that are highly socially intelligent and can read the room, that can communicate effectively, that can look people in the eye as they're having conversations, is a really important quality on teams today. And it's also the second largest contributor to collective intelligence of a team. And the third is diversity. Talk about a topic du jour, right? I mean, this is the topic du jour today. not only in the academic community, but in corporate America. There are many diversity initiatives, and again, it's for very good reason. This is the third largest factor driving team performance and collective intelligence on the team. What's important about diversity, though, is that there's nuance to it. We're not talking about social diversity, ethnicity, race, gender. What we're talking about is cognitive diversity. The ability to think and process information differently. And so what we talk about here is having high cognitive diversity on the team, people that come from different perspectives, that think through problems differently, but low values diversity, meaning that they have a similar value system. So if you have 5 people around a table and one person's a long-term investor focused on quality, another person's a short-term investor focused on momentum, another person's a real estate investor, another one's doing M&A deals, not the most collectively intelligent team because they have a different value system. They value data along different dimensions, they value, their time frame is fundamentally different, not the most collectively intelligent team. However, you get a team together and they're all focused on quality investments, intrinsic valuation, and over a long-term perspective, and they're looking at everything from that perspective, and they're thinking about it differently. It's a highly collectively intelligent team, and you're harnessing diversity in that way. What's interesting about diversity is you can scour the academic literature on diversity, and there's actually very little evidence that suggests that diversity actually produces better results. It produces the potential for better results, that's unchallenged. But actually producing results, it's not well documented. And the reason for that is that teams are more difficult than that. There's 2 dimensions of team. One is the information processing. So how the team contributes skill and information. This is the value creation mechanism of a team. Can you think, can you process information and think through information? But then you have to transfer it. You can't just have a bunch of individuals thinking critically about a problem and not get into a team B environment and share that information freely across the team. And it's the transfer piece that often fails in the investment business. You often find a team A type environment. You often have information held back because of hierarchy. And the transfer piece is really difficult in this business. So again, bringing it all together, a collectively intelligent team will emphasize these 3 factors. One is the pattern of information flow, how information flows across that team. You want a team B type environment, equal distribution of conversation among the team, all ideas out in the open. You want a highly socially intelligent team of individuals that can truly communicate and look each other in the eye and understand when to push and pull back. And you want a diverse team, not just socially diverse, which is a great proxy for cognitive diversity, but true cognitive diversity, people that think and process information differently along the same value system. This is the recipe for highly collectively intelligent teams. And again, it's not easy. It takes a distinct effort, focus within an organization to build not only the people within the organization, recruiting, retaining, and transitioning people, as well as the culture within the organization to perpetuate this type of an environment. We think it's a critical aspect of the success of investment management into the future. And so it's certainly something that we spend a lot of time on within our own teams, and it's something that we believe passionately about can help investment committees, internal investment staff of our partners. So I will stop there and turn it over to Bob to start having a conversation around how we start taking this into the dimension of time.
Thanks, Sean, and thanks, Cindy, and also if the folks from Heartland are in the room, thank you as well for recommending us to Cindy. And I would also just echo Sean's sentiments about your society here in Cleveland. I live in Chicago, and there's a society there, but I don't think they have an active schedule like you have here in Cleveland, so congratulations on that. So thank you. Now that Sean has articulated the 3 major factors that contribute to building effective teams, my portion will hopefully start to take the stress out of your life. We'll look at the benefits of using time and alignment as your allies in creating positive outcomes and supporting relationships both internally and externally. So David Swenson, who is CIO at Yale University, has been since 1985, and as I researched him, he was listed on CIO's magazine's list of 100 most influential institutional investors worldwide in 2012, and has been a pioneer in thinking about investments and teaching others during his tenure. He carefully manages the group dynamics of his staff, holding a debate of ideas on a weekly basis, avoiding groupthink and shifting away from consensus, while utilizing complex asset classes and pursuing asset allocation decisions for the long term, really not being bogged down in short-termism, and is certainly to be applauded. So, why is the marketplace so short-term oriented these days? It's a question we certainly ask ourselves at MFS. So here's where the stakes are high. As you well know, meeting return targets has become increasingly challenging and more complicated. And maybe you've seen this chart before. Investors today either have to take on 3 times the amount of risk to get the same return as 20 years ago, or said another way, those who try to maintain the same risk as indicated by standard deviation over time experience significantly lower returns. You just can't win. So that search for return is creating a lot of angst and a need for control, driving the industry to become focused on near-term results and micro-measurement to manage the increased amount of risk. So what's really happening? At MFS, we conducted a survey of 100 North American investors regarding investment decision making. We asked a few questions. The first one was about time tolerance. How long are you willing to tolerate the underperformance of external asset managers before initiating a search for a replacement manager? Interestingly, 82% of the respondents said between 1 and 3 years. Then we also asked about board demand. What time frame are you given within your specific organization to generate a positive return for your assets? Here, 69% of the respondents said 1 to 3 years. These numbers confirm that investment decisions continue to be anchored within short time frames. Maybe this is related to the fear of personal career risk of underperforming. And these days, most professionals really want to hold on to their jobs, especially in light of all the political and economic uncertainties we all face. So as you know, most skilled active managers in the marketplace look to generate consistent alpha over a full market cycle, and there's good reason to do that. However, the accountability metrics to measure skill and the understanding of timeframes of a full market cycle are rarely discussed when managing objectives and ensuring alignment. No one seems to go there. The industry is fixated on 3 and 5 year timeframes or less to assess skill. In reality, the 3-year time period is less than half of the historical time period of a full market cycle, which is 7 to 10 years, either peak to peak or trough to trough. I kind of laugh when I see this exhibit, in the sense that in my role at MFS, I work with the investment consultants in hopes they'll approve MFS strategies for use with their institutional clients. In this due diligence process that I deal with day in, day out, the consultants do an amazing job of evaluating our long-term performance results, our people, our culture, our process, and investors, pension funds, not-for-profits, sovereign wealth funds, they all have long time horizons. And we state that our goal is to perform over a full market cycle. which is all well and good. However, once hired, the challenges begin immediately with short-term performance reviews, which create misalignment and much tension in the relationships. It's an industry-wide issue. It's not an MFS issue. It's what we're all going through. So here's what happens. We hire top quartile managers. When they underperform, we fire them, and we hire the next top quartile manager. It is well documented that manager churn is costing investors 80 to 150 basis points annually. Not to mention the time sunk focused on the wrong metrics, when better time should be spent understanding the attributes of the skill you hired. More difficult to measure, for sure, but they far outweigh relying on past performance as our future guide. Interesting. So then we wanted to see what happened to the bottom quartile. The reverse happens to the bottom quartile managers. They move to the top. While you may not typically think about hiring a bottom quartile manager, giving these results, maybe you want to adjust your thinking. As one of the greatest investors of all time, Warren Buffett's portfolio exemplifies the need to focus on long-term and not be deterred by short-term underperformance. According to Forbes' 2017 billionaires list, Warren is the second wealthiest individual globally. He is worth in the neighborhood of $75.6 billion, and he has signed the Giving Pledge. Warren has said, and I quote, "Because we're not going to sell the business, we don't need something with earnings that go up the next month or the next quarter. We need something that will earn money 10 and 20 and 30 years from now. And then we want a management team we admire and trust." So, time allows strong, active firms to conduct quality research, identify good values, examine material issues such as ESG in determining the viability of sustainable business models, all the while understanding and managing risks to add value for clients. Time provides an opportunity for investors to demonstrate their skill, expertise, and discipline for the greatest impact for client portfolios. As you all are aware, pro-cyclical investments, or herding, can be one of the greatest risks to responsible investing in long-term outcomes. Following the herd at the wrong time is when skill becomes completely irrelevant. Value is created through original, thoughtful, and informed research. Additionally, misalignments between asset owners and managers are really solvable. The expectations on both sides must be in sync for long-term success in investing. So how can this be implemented? Alignment. So how can expectations be managed to lower the stress for all involved stakeholders? What can we do? First, goal setting. Right from the get-go of a relationship, how should goals be articulated? How should we think about success internally and with stakeholders? This is a critical element. making sure goals are appropriate for long-term success. Is there discussion on purpose, investment beliefs, and time horizon? One example that we've been looking at is our investment management agreements. Is a full market cycle really spelled out in these? Is it defined? And then partnerships. Are partnerships with organizations long-term oriented? How does this translate into performance and fee discussions, engagement? Investment firms must constantly challenge themselves in these areas. For us, one example, as I thought it through, is how we've addressed the development of an investment solutions group. This involves a dedicated team of professionals who are highly integrated with both the investment team and distribution to provide value-added insights, global perspective, research, and client engagement across channels and regions of the world. What are some of the relevant deliverables? How do we think about this? We think about macroeconomic commentary, long-term capital markets expectations, client and industry insights, as well as investor insights. At the end of the day, as a world-class investment manager, we need to show clients in very tangible ways that we're all in it for the long haul. We're focused on value-added solutions, whether they use us for one mandate or multiple mandates. And then finally, measurement of skill. What are concrete metrics that can be used to be objective in evaluation? Again, how do we get away from just the short-term performance reviews? There's a number of thoughts here. One is an example of showing long-term numbers first in presentation books, which sounds so minor, but it's actually a huge project. Showing rolling time periods rather than just one time period. Hopefully 7 years or longer. Showing consistency of style. Are you doing what you said you would do? Compensation. Is there alignment between portfolio managers and analysts on performance to be in line with the investors? We took a look at this, and 80% of the marketplace uses 1 year performance numbers to compensate their people. Time tolerance. What are the guidelines for this? Going back to my earlier slide. Is it short-term in nature or is it longer term? And how do folks think about that right from the get-go? Benchmarks. How should these be thought about? Should there be a primary and a secondary? Active share. Do you look at active share? Do you look at average holding horizon? How do these play into evaluating a manager? So I guess in considering these three factors, goal setting, partnerships, measurement, in terms of being aligned with an investment manager, having those discussions and changing the dialogue and getting away from the short term, all I think help in terms of generating and encouraging a greater success for everybody involved, and hopefully less stress. So thank you, and I'll leave it to Sean to provide a wrap up.
Yeah, why don't you just stay here and we'll open it up
Sure.
for questions. Maybe one tangible example of how measurement can matter. So we work with a big, large union pension in the DC area, and we've been pushing him to start implementing some of this stuff with his own board because he feels that pain. And he was successful in moving his board away from every time he had a manager underperforming on a 3-year basis, he had to do this full write-up. He had to visit the manager, he had to do all this research and prepare this presentation for the board. And in combination with some of the work that we provided for him, and he partnered with some of his consultants and others that he works with, he was able to get the board to move to rolling 5-year to do those reports. And he tells me, this is probably gonna save me a month of work every year. And so he says to me, just think about the value-added stuff that I can do to get us to better long-term outcomes with that extra month every year, just because I moved the board off of this 3-year number. So this is why we say that there is some low-hanging fruit out there that we can start addressing in a really systematic way to start moving our stakeholders, our boards, our committees, our partners into more of a long-term perspective. And the reality is we think that freeing up the time and the lack of short-term pressure is going to give professional investors the opportunity to truly be more long-term oriented and harness the skill and the human capital that we talked about in the beginning. So let's stop there. We have a little bit of time. If you guys have any questions, if you want to challenge what we're saying, if you want to have any questions, we're happy to answer. Yeah.
I'm curious of your client base here. What's their feeling on active passive management, and do you see the trend going one way or another?
Yeah, I'll speak from a client perspective. I think you can add anything from a consultant perspective. Definitely feel the movement to passive. And I think in some ways it's a healthy dynamic, candidly, because if you look at the investment business, there's probably a decent amount of investment organizations that probably don't have the sustainable long-term skill to be viable. And on the other side of it, I think it's the result of some short-term thinking. So if you look at a lot of the rationale for moving into passive has been active managers can't perform over the past 5 years. Well, it's been a bull market rally and we've had a certain market environment. I will often tell clients, I can't tell you with any level of certainty over a 3 and 5 year period if we're going to deliver for you. I can't.
So are you telling who you're consulting that they should be moving more toward passive management?
No, so my final statement was going to be, what's healthy about it is it's forcing, in my opinion, the active community to start disaggregating where their skill is. The movement towards factor-based investing, smart beta and low-cost factor-based investing, it's forcing the active investors to start disaggregating where the skill is. Is it just factor exposure? In which case, go get it cheaply. Don't pay for an active manager to do it. Is it truly long-term sustainable skill? In which case, in our view, it is worth paying for that. And we believe in what I was describing with a 3 and 5 year period. We have a high degree of confidence that over a full market cycle we can deliver. Over a 3 and 5 year period, it's highly debatable, even when we talk with our clients. And so the conversation we want to be having with our stakeholders, our clients, our consulting partners is, we want to be aligning ourselves with institutions and organizations and individuals that are willing to think over a market cycle and a long-term period. And we're very happy to engage in where does that skill come from? How do we maintain that skill over market cycles? But if you want short-term, cheap beta exposure or factor exposure, the active community should be very open to allowing that to happen, in my opinion. So I think this disaggregation and understanding where skill comes from is a healthy dynamic. It's painful for firms like us, no doubt about it. But ultimately, I think as an industry and as an organization and an industry that's focused on driving successful outcomes for individuals and institutions, I think it's actually a long-term good thing. Yeah.
So as someone who works with private clients primarily, how do you take the conversation turn-taking from, say, an investment team to a team-type client meeting where you have a client, and then you might have a couple of your colleagues with around the table. Any thoughts around how that can map over into in those types of situations?
Yeah, 2 thoughts. One is you have to understand, is it a team dynamic where you're trying to drive the best decision? Or is it just a conversation with the client and trying to convince them or explain something?
I think it could be either way.
Yeah.
I think, ideally you'd want still that team B type of, back and forth,
Yeah.
Listening and all that. But,
Yeah, so I would think about it as an internal organization. How are you going to orient yourselves, drive compensation and strategy and goal setting internally to encourage a team B type of environment, right? To arrive to the best conclusion and decision for that client. And I also think the second opportunity is educating your clients. My guess is a lot of high net worth individuals sit on boards and committees at institutions, and so I think it's a really valuable conversation to be having with clients And if you can start instilling that kind of a mentality in client meetings, I think that's even better. But I think that's a bit of a bigger stretch to actually do that, unless you have the broader conversation with the client. But I think so. Some of the most interesting research on this subject of conversation turn taking, when you go a level deeper, actually comes from family systems. So David Cantor was a Harvard psychologist, and he wrote this book called In the Family, and it dug into how conversations happen from a family psychology perspective and the dysfunction of family systems. And there's a whole level of research on that. We can talk about that offline if you're interested. But my point in saying that is a lot of the research today on teams and building effective teams and effective conversations on teams comes from that family psychology. So the ability to have these conversations with clients can span a lot of different dimensions. And so I think having the conversation with clients is just a starting point to more value that an advisor can bring. Yep.
On the cognitive diversity, I guess how do you identify it, or I guess what different types of cognitive diversity are there, or how, how do they think about that, or how do they identify that in the study?
Yeah, it's a great question. So it's really about experiences. So if you think about it simplistically, it's less about, so you think about social diversity, which is pretty easy to identify. Cognitive diversity would be about where did you go to school, what was your area of study, where did you grow up, did you have diverse experiences, industry credentials, so your academic path. So there's a checklist of things that you can look at along those dimensions that are more about how you think about problems, and then it's about how do you interview for that. What are the questions you ask, and how do you get people to think about it? I think the management consultant community does it pretty well. They give a case study to an individual and say, solve this and help me understand your thought process. That's a pretty interesting way. We do that with our analysts. We give them a stock or a bond and ask them to evaluate it and tell us how you got there. That's an interesting way to understand how people think, and is it going to be complementary or just exactly like everybody else? In which case you can think about how they fit within a broader team. So it's a different sort of heuristics that you're looking for, but it's not scientific in that there's like a personality test or anything like that. Yeah.
Go back to the smart sense. So the strong metaphor, the strong sense.
Which one?
The strong metaphor. That's have a category of different assets.
The category of what?
Do you have a page number?
Oh yeah, this one.
Oh, this one, yeah.
Yeah. So I want to know from the pictures we can see the high probability that the users can event in the future. So and I see that your methodology is positive methodology. Is a help of the asset managers to allocate your asset. So what's your focus on? What's the focus of your asset?
What was the universe?
What's your focus? You pay attention to which kind of assets? This for years.
Yeah, well, so the quartiles, how do we?
I think he's asking
The
how
methodology
you
of-
forecast the future based on that.
Oh, okay, so then basically the methodology of this chart.
Yes, that's
Okay,
exactly
so
right.
what we did is we looked at the investment universe. The U.S. equity universe, we included an adjustment for survivorship bias, and we looked at rolling 5-year numbers. So if you look at the top of these charts, we went back to 1990 and took rolling 5-year numbers and then moved those same managers forward 5 more years. And so what you see over that, and then you sort of played that out until 2015. So we looked at basically a 25-year sample. And so what we did is, if let's say you're a manager ABC and you're a bottom quartile performer in that 1990 to 1995 period, we then looked at your quartile ranking for the subsequent 5-year period, and then the subsequent, and moved it forward like that. That was a methodology from it.
And I don't know whether folks are familiar with eVestment, but they're a huge database for most managers. So it is a big set of data.
Have you run the same thing with just international, and would the outcome be the same? Because you said it's
Yeah, it's a good question. We didn't run it for that, but we could, if you want to give us a card, we could test it and send it to you. It's actually a pretty manual process.
I'm curious if the outcome's the same or not.
Yeah, I think directionally it will be very similar, but we don't have the data offhand. The point here is, I mean, I think it's a valid and interesting point in terms of the directionality of it, but the point that we make here is just challenging the wisdom of investment committees, right? So when I talk to a pension board, I'll just ask them, like, when's the last time you even considered hiring a bottom quartile manager? And everybody laughs because they know, like, the fortitude you have to have as an investment committee to sell that is really difficult, right? And so it's almost like the bottom quartile is off the table. And I still think it's probably a long shot that you would hire a bottom quartile manager, but the point is you should actively consider it. You should be thinking about it and challenging, you know, am I missing good opportunities just because this manager is underperforming right now? So, you know, while I recognize that the data itself is super powerful because U.S. equity is really stark, I think it's more about just the mentality of how to think about it. We're not actively out talking about you should be hiring bottom quartile managers. It's more challenging the conventional wisdom.
Well, and I think looking at them actually gets you beyond performance to say what's really going on at those shops and how are they managing money and what's their style and, you know, how are they doing things and what's their culture and kind of other things rather than just numbers. Before I went to the investment management side, I was on the consulting side and was researching managers. And as Sean says, I think it's very hard to propose a bottom quartile manager, but sometimes it really should be where you should be looking.
Is there a question over here?
I was kind of answered already, or maybe I can talk about it afterwards, but you know, kind of piggyback on some of the other questions that were asked. When you did this analysis, did you find any type of commonalities amongst bottom quartile managers that moved up to the top quartile? Was there some sort of style bias, factor bias, more than just went from picking good stocks to picking bad stocks and back to picking good stocks?
No, it's a great question to ask a consultant. we didn't dig into it because it was just an understanding of it directionally if it's a conversation we should be talking about. So.
What about anecdotally from your own, bench of managers? I mean, have you seen, managers that have been in the bottom quartile go to the top quartile and vice versa? And I guess, what were the reasons for that? I mean, what, as he was relating to like style change, fundamental versus quantitative or some other, type of style that was out of favor, went into favor,
Yeah.
vice versa.
Yeah, I mean, I think internally at MFS, because we're focused on quality, valuation, long-term perspective, it's rare that there's a market environment that's so long-term sustained that we're in the bottom quartile. But I could absolutely see highly skilled managers that have a very differentiated approach. Maybe it's some sort of quant strategy, or they're leveraging some sort of particular bias in a market momentum or something. I could see a period where a highly skilled manager could, for over a 5-year period, be bottom quartile. And you see a decent amount in the international space where they might be in frontier markets or EM early, and you may want to hold on to them because that could play out and be positive to performance. So, from personal MFS experience, we don't have any sort of anecdotes that we can share in terms of where we've seen that play out, but I think there's plenty of opportunity for that to happen if a manager is taking a very unique approach in the market. I mean, looking at the past 8 years, it's been a distinct market, and you could see periods where there's really talented managers that aren't delivering over the past 7-8 years that likely could perform over the next 7-8 years. So I don't think there's one particular factor that we could point to, but I believe it's out there. Yeah. Sorry. Yeah.
On the subject of alignment, does MFS offer performance-based management fees in their separate account space?
Yes. We've actually, anecdotally, we've taken it a bit of a step further to say, what if scenarios. This is a safe place, right? The recording's on. Why do we price on scale in this business? The more money you give us, the better price you get. Why do we do that? Our best clients, and I go out talking with clients all the time and hopefully convince them to join us. We want if you're going to evaluate us on 3-year periods and anchor to that, we don't want you as a client. No offense, you're a great organization, but you're just not a good fit for us because we're going to be constantly defending ourselves and constantly explaining why we're underperforming. And it's just not a productive, it's that tension and that tug of war that Bob was talking about. Not a good alignment of interest there. There's plenty of firms that would be great partners for them. So why not start pricing on time? There was an example earlier this year with a big public fund that we actually put a time-based pricing structure out there where the discount got more and more, the more of an implicit lockup that we would provide. This is kind of untested waters in this business, but why not? If we commit to a full market cycle, we want to give you a big discount. Committed capital for us, we're aligned along the dimensions of time. We have a higher degree of probability of performing for you. You're likely to be looking into what we're doing in a more productive way. Are we keeping our talent? Are we motivating them in the right way? Are we providing opportunity for our young people? Those are the kind of alignment type partnerships we want to be having. So why scale? Why not time? Why not more performance-based measurements over longer periods? But performance-based fees are also challenged. What's the look back? The 1-year performance, the 3-year performance, right? So there's a lot of alignment challenges in this business, but I think what we're saying and what we're recognizing, what we're trying to perpetuate in the market is we should be challenging the conventional notion. And it's worked very well for us in the past. We don't have any interest to change it outside of we think it's in the best long-term interest of our clients, the industry, and we have a high degree of probability of being successful for them. Yeah.
So what's the right size for, say, a small firm? It sort of sounds like a small money manager that has a few people, may not have enough diversity to get enough cognitive diversity.
It's highly debatable. There's no leading research you can point to that talks about an ideal size. Some will say 4 to 6, some will say 8 to 12. It's how you structure that team. So just, again, speaking for personal experience at MFS, we use teams and collective intelligence to inform individuals to make decisions. So some organizations might be consensus-based, where the team makes a collective decision. That's one way to do it. We look at it as, if I'm an analyst, I want to be participating in a highly collectively intelligent team, challenging my view, providing unique inputs, allowing me to put out a thesis and have a conversation on it. And then ultimately it's my responsibility as an individual to make that decision. So that team size and composition might be very different than a consensus-based team. So there's not an easy answer to that question, unfortunately. But what I would say is your goal is to maximize those factors. That's what the MIT research tells us.
And I think it's not there's no magic number. I think it's more how do you structure your team and how do you do things around that. I like what I was talking about earlier with compensation. And at our shop, we do a lot in the way of 360-degree reviews. So analysts are reviewing portfolio managers are reviewing analysts, and we have that on the distribution side as well. So everybody's kind of used to that culture, and each person really should have a voice.
We do have another presentation that we could share if you're interested called Designing Collectively Intelligent Teams, and it gets into goal setting, process, information flow, hiring, incentives as a system and how you might think about that, which is leveraging some of this research, but also more research we did with MIT and their leadership center. And so we're happy to share that. And if you want to give us a card, we can send it along and share that. 1:15. We're happy to stay, but just being cautious of time. Well, we really appreciate it. Thank you very much.
Thank you.